So as mentioned, I'm Elliott Krivenko. Thanks for having us back. I was here last year presenting for CoStar. This year I'm joined with my colleague John Gillem from Portland, and so we're going to give a little bit of a broader outlook, do some comparisons, Seattle and Portland, and talk a little bit about what's going on the east side as well going forward. But first, just to ground ourselves, I usually pop up a map at the beginning of all of my presentations. I like to make sure we know what we're talking about when we're talking about data. And so in the case of Seattle, the Seattle region, we're talking about the Tri-County. So King, Pierce, and Snohomish County is what we mean when we say Seattle market.
Yeah, and in Portland, if everyone can hear me okay, that sounds pretty good. We're going to spend a lot of time talking about dive into the Washington side of the river there in Vancouver today. But we're focusing on that larger 7-county area. So starting on the Washington side, Clark, Skamania County. And then on the Oregon side, we've got Multnomah, Washington, Columbia, Clackamas, and Yamhill counties that make up the collective Portland region.
And just kind of some broad overarching themes from the presentation. So going into 2024, we've seen some wild swings in regards to, I should say we're going to focus mostly on multifamily and office here, just so it's not an hour-long presentation. So for multifamily, we've seen some wild swings over the last few years. Some of these patterns are not too surprising given what we saw in the economics presentations. Rental rates going sky high back in 2021, things coming back down to earth in the time that's followed. We expect to see some balance starting to return to the market in 2024 with demand starting to tip back up, construction slowing. This does vary a bit by submarket, and you do see areas with a lot of new construction seeing a lot of concessions as well. Office still seeing some challenges there. We've seen a record decrease in the amount of occupied space over the last year in the Seattle Metro, and we do expect that reset could take some time. I do expect, partly because of the connectivity between these cities, that downtown Bellevue, Spring District, and Redmond should outperform within the region.
Yeah, and going off of what Elliott said, I think a theme everyone's going to notice today and sort of to keep in mind is that a lot of what's happening in Seattle is going to be happening in Portland too, just on a little bit of a smaller or reduced scale. Few exceptions, but like Elliott said, multifamily, we think that we've probably hit a floor in demand to give us a little bit of a base to boost off of going into 2024. Slowing starts, shrinking construction pipeline, which means less competing supply, and a recipe for vacancies to peak. Concessions, however, should remain prevalent through the year to get those units leased up. But overall, Elliott touched on it already. That the word balance coming back. Office, got to say ditto to what Elliott said as well. With one difference being, Portland's not nearly as exposed to speculative construction. So big high rises going up with no tenants in place. We're not seeing so much of that in Portland. 2 of our speculative high rise projects delivered in downtown, and we don't have much underway after that, as we'll talk about later. So we will get into it now, starting with multifamily.
So we'll start off with demand. We'll throw out the term absorption a few times probably throughout this presentation. And for those who aren't in the industry, that's essentially the net change in occupied space from one period to the next is all that refers to. And in Seattle, so I've got my cheat sheet because I tend to not throw out a bunch of statistics, but I decided I'm gonna do that this time. So absorption over the last year, 2023, or going back in time, 2023, about 6,000 units. And that is a bit of a slowdown from the 2010s. During that period, we had some pretty strong activity locally, a lot of growth, 7,800 on average over that period. So it's a slowdown from the 2010s. It's a slowdown from the year before as well. We did see strong absorption in both downtown Seattle as well as Tacoma, more than 1,000 units absorbed in each of those submarkets. Again, there are a lot of new construction also in those, which we'll get to in a moment.
Thanks, Elliott. Yeah, and again on the scale aspect, reminder, Portland in the yellow bars there, but Elliott mentioned about 6,000 units taken or absorbed in 2023. Portland, we had about 3,500 units leased up and absorbed during 2023, and that's slightly above the low point we saw in 2022 of just over 3,000 units, but again, below that 10-year average of 5,100 units. And that mark was driven high by the 2021 figure there of well over 9,000 units as the pandemic era effects took place and people were shifting out to the suburbs and a lot of other factors were going on. But again, a bounce back, a little bit of an indicator of a bounce back in demand. I said we'd talk about Vancouver. Here it is. Vancouver absorbed about little over a third of those 3,500 units. So about 1,200 units leased up in Vancouver last year, partly due to all the supply coming online there, but also partially because of the favorable income tax environment. Residents can live there, go across the river to shop, and cost of living. It's cheaper to live in Vancouver, and so they're starting to pull more residents to that side of the river. And most of the in-migration we're seeing to the area is landing in Vancouver as well. So.
I promised we'd talk about construction. So construction is slowing, but it still remains at a fairly high level, especially for Seattle. So we hit a peak of around 27,000 units underway at any given moment. Towards the middle half of last year, that's now down to about 25,000. That is still about 40% higher than the average level in the 2010s. To throw some numbers out there, so about 9,700 units were completed last year, and that compares to about 7,900 in the 2010s. And so that piece has picked up, even though as absorption has slowed, construction has ticked up during that period.
And sorry, Elliot, I get the laser, it looks like. But it's a little bit of a visual help. But so in Portland, we peaked out. We had a kind of a second peak here in late 2022 of about 12,000 units underway, or a little over 5% of inventory. I wanted to note this flattening here in about 2017 was due to the inclusionary zoning that was going into effect in Portland. So developers really raced to get their projects grandfathered before that came into effect, and those affordable units had to be built into every new project that came online after that. So we saw a surge in units getting permitted here, and then sort of drop off during the pandemic as materials shortages, labor shortages took effect. And a lot of what happened here in 2021, this kind of snap back in the pipeline, was due to projects that were permitted before the pandemic, a lot of high rises in the core submarkets that have now delivered, and giving the units that are delivering in Vancouver on the Washington side of the river, now we're seeing the pipeline shrink again. So we had about 3,200 units enter the pipeline in 2023. But again, the 12,000 or so units we had underway in mid 2022, that's down to 7,700 units now. So about a 38% drop in the number of units underway, and starts are slowing as well.
So you put that together, supply, demand, that's going to impact your vacancy rate. So we are including in this vacancy number new construction. And so as a result, you can see that that's ticked up over the last year. We've had more units delivered than we've had absorbed. And that's caused the vacancy rate to rise from about 6.5 to around 7%. We anticipate that will start to even out this year as supply and demand even out a bit. I will say, 7% sounds like a lot. but kind of a normal background would be maybe 5% vacancy rates. And we do have some cities in the region that are actually below that level when you exclude new construction, and that includes Kirkland, Redmond, and Bellevue.
So a similar chart, right, in Portland, a little bit different, but similar. We also, Elliott mentioned that 7% figure, seeming, relatively, large, but it's actually, if you look at the green line there, it's near the top, but it's not like it ran, really out of control to that double digit level that we're seeing in some Sunbelt markets, Austin, and some Florida markets. So we do expect that to be the peak, about 7.1%. And although that's above the 10-year average vacancy rate of about 5.9%, again, we think that given the slowdown in the number of units started, the demand floor being reached, less units coming into the pipeline, maybe a little bit less in the way of options for renters, that those units are going to absorb, and that vacancies have reached their peak and are going to start, to gradually decline there through 2025 and 2026. And that means, in terms of, we have one more slide to show overall, how do things look over the last 10 years? I was getting ahead of myself. I was going to get into rent growth, but we have one more slide. So how do things look over the last 10 years? What have we built in relation to what has been absorbed? So those red bars show you net deliveries or completions of units in each market, and the green bars are going to show net absorption. How many of those units have we absorbed? And we have a little bit of, as is clear, a little bit of an imbalance. And Elliott and I ran, if we believe, right, Elliott, that if we were to run this chart in a year, given the slowdown in construction, slowdown in starts, Dana talked about interest rates. Construction financing is expensive right now. It's going to stay expensive. I think labor will continue to be a challenge. We think the green bars are going to start catching up here a little bit as less supply enters the market. So that gap will narrow, right? Right, Elliott?
I think so. I would agree with that.
Yeah. So now we can get into putting all these together, what effect we've seen on rents.
Yeah, so rent growth, like I mentioned, 2021, things just kind of went gangbusters, and we saw double-digit growth that year. Saw it coming back down to earth since then. Some areas have seen some have seen some falling rents over the past year or so. And overall, Seattle did end the year with positive growth. That does differ by submarket. I mentioned earlier about areas with a lot of new construction, seeing heightened concessions. Well, they've also been areas that have been challenged a bit with rent growth overall. Some areas in the region that have the highest amount underway as a percent of inventory that's going to create some challenges here include Shoreline, downtown Seattle, and potentially Redmond, although we do have the light rail opening, so that should help spur some demand there as well.
And in Portland, we actually saw a pretty dramatic fall in rents in 2023 overall. Rents eroded by about 2%. I'll tie some of that back into population mixed with the amount of supply that was hitting the market at the time. So the Portland proper, it was estimated, lost about 10,000 people in the most recent census release. We expect that number to be negative again when the next reading comes out. I believe it might already be out, Elliott. So that combination of population loss in Portland and a lot of units coming online meant landlords had to start getting competitive to secure tenants, offering a lot of concessions and lowering those face or asking rates. So we saw rents slip a little bit in 2023, but as Elliott said, we're expecting a rebound in 2024 to about that, somewhere in the range of that long run average, 3.5%, 4%, that target range. And so a pretty smooth amount of growth there, given the balance we've seen on the other slides with construction and demand. So in Portland, to throw some figures out there, Hillsborough saw rents decline by about 5%. Downtown, it was similar, although we expect submarkets like Hillsborough to outperform going forward. A lot of construction activity and expansion going on at Intel, which should make up for some of the job losses we're going to see at Nike, which we'll talk about when we go over the office slides.
And then finally, the last metric for multifamily sales volume. So not surprisingly, rates are up, cost of debt is up, sales are down. So we saw about 50% of the, or less than half actually, of the sales volume in dollars in Seattle for multifamily than we did the year before, ending the year with about 3 billion. And it's like sounds like a huge number, but it's the lowest level that we've seen since 2011 in this region. We've also seen a shift in the types of properties and the types of buyers that are in the market. From we're seeing record-breaking high-rise deals a couple of years ago. Now we're seeing more on the garden style communities are what's trading. Large institutional players, now more private investors. And then also the price points are obviously very different now, much smaller deals trading now than say a couple of years ago.
Yeah, very similar to what Elliott said in Portland. Just around $1 billion in deals in 2023. Again, sounds like a lot, but when you compare it to the nearly $5 billion in deals that we saw in 2021, there as investors rushed in to capture the at the time solid rent growth and steady population growth in Portland. When you compare those, it's a huge drop off. Similar to what Elliott said, we're seeing the same thing. Private investors moving up the quality scale as institutional money remains pretty much sidelined right now, at least in Portland. I've gotten some calls from investors that are looking, but not a lot of action just yet. So the private investors are pushing those largest deals, trading into those core or maybe core plus or fringe core plus assets right now. So that's kind of what's going on the capital markets side. And I believe, yes, now we're into the office sector, which I think everyone kind of knows the current, what's going on in the current office environment right now. So we'll dive into what we're seeing with the data, starting with demand.
Yeah, so hopefully we can find some green shoots here. But,
Yeah.
Yeah. So I mentioned earlier, we had a record year of negative absorption in 2023. So that's what does that mean? That means about 4 million square feet less are occupied in offices now than there were a year ago. If you want to know the cumulative since 2020, that figure is about 10 million square feet. And we anticipate over the next year, our forecasts are showing about another 7 million on net being vacated for office space. For context, for historical context, this shift that we've seen since 2020 represents about 4% of the total inventory. And looking back to the tech bubble in the early 2000s, that downsize was about 2% of the total inventory. So quite a bit more here. I was asked to bring in some stats with some other tech markets. And when you compare what we've seen in Seattle to the Bay Area specifically, San Francisco saw about 9 million square feet of negative absorption over the last year. So we're actually doing a little better than San Francisco. San Jose and the East Bay, about 4 million negative square feet in between those two. And as for what's currently available and on the market in Seattle right now, I'll throw this in there because it's something that I get asked if I don't. About 43 million square feet of office space is currently listed on CoStar as available in Seattle.
Yeah, and it's a similar story. Going off of what Elliott said, it's a similar story in Portland. Again, like I said, just on a smaller scale, right? So we saw about 1.2 million square feet of negative absorption in 2023. Not quite to the level we saw in 2020 when we saw about 1.7 million square feet of occupied space lost. But in 2024, we do expect that number to continue to increase to about 1.5 million square feet of negative net absorption. A lot of Portland's problems right now are in the core. We have tenants fleeing the core to some of the western submarkets, some of the more southern submarkets like Cruz Way and Lake Oswego. We'll talk about that. But Portland, the bulk of Portland's office product is in the core, and that's where we're seeing most of the issues. Availability is there in the 30 to 35% range. And despite some commitment by law and government tenants to the core, most of those commitments have been to the brand new deliveries, Block 216 and 11W, those 4 and 5 star assets. And what those tenants are doing is they're leaving behind Class B plus and A minus space and shrinking their footprint by 25 to 50%. So it leads to an erosion in occupancy for the leasing that we are seeing in downtown.
So yeah, construction slowing down. It looks pretty dramatic there with the Seattle chart. Surprisingly, looking at this, you wouldn't know it, but Seattle is still among the most active office markets for new construction in the country. I believe it's second to Boston, if I'm not mistaken, right now. We saw 5 million square feet delivered last year, and we're expecting about almost 3 million this year. Last year, with what was delivered, a lot of it was pre-leased or owner-occupied, so it didn't have a huge impact on our vacancy rates. We are seeing a little bit of an uptick in the amount of speculative space in Seattle, but still kind of low relative to a lot of our peers.
Yeah, and in Portland, we don't see near the amount of speculative construction that Seattle sees or institutional activity. This decline we see here to level us to the point we're at now in terms of square footage underway as a percentage of inventory was given those deliveries in the core that landed, and now we've just seen a flattening. No one's breaking ground on anything major. And when, as Elliott pointed out, when they are, it's typically medical office or it's for owner use, so it's build to suit, fully occupied. So that's one reason we believe Portland will have, as we're going to see in the coming chart, a shorter run to peak vacancies, is because we're not going to be inundated with supply delivering to the market that's going to be empty and difficult to lease.
So again, that net result, supply, demand, what does that do to vacancy? In Seattle, we've seen vacancy rise over the last year from 10% to 14%. A lot of this is due to renewals coming to due and not actually happening. A lot of it, as John mentioned, a lot of companies are downsizing. Fairly typical is a company, if they're leasing in their existing space, they might take only half, or they might move and take half. A good example recently was Perkins Coie in downtown Seattle, going from about 300,000 to about 150,000 or so square feet. So that's leaving another 150 on the market and available. And then downtown Bellevue, seeing a lot of new availability down there. Although I will say, I don't know if I have this in my notes, but downtown Bellevue in the last few months has had some pretty strong leasing. I don't anticipate that that availability there is going to lead to vacancies to rise above the average for the metro. I think it'll just come a little bit closer than it is now. But we are seeing some activity there, which should help kind of ease things a bit over the next year or two. Yes. So The availability does vary by submarket. I put an asterisk on that first one, DuPont, just because in the way we have our database set up, it's such a tiny submarket that there's one property that's really accounting for that. So I'm not going to talk too much about that. But for the folks in the room, I think the next one is fairly interesting. I-90 corridor at one point had the fastest rising vacancy in the nation, and is now at about 44%. I think that number might have even changed by a percent or so since I pulled this. Um, but the good news is I don't think that corridor is going to go too much further, if only because we've sort of already worked through all of the expiring leases at this point. So I can't see things. I hope I don't regret saying this, but I can't see things getting too much worse in that area. But again, that's going to be a challenge. A lot of fairly aged inventory for the most part. Not super walkable. If you work there, you're probably driving. And so I think being in competition with downtown Bellevue, some of the other areas that I mentioned before, Spring District and Redmond, is going to be a little bit of a challenge for the I-90 corridor going forward.
So as we kind of move back to putting things all together for Portland, you'll notice our peak vacancies there topping out, like I said, at 15%, and that's not thanks to office use and employment growth, and it's not thanks to absorption. It's mostly due to that huge slowdown in construction activity and supply there in the blue bars, and so Portland is again just much less exposed to that when we compare it to other markets. Obviously, employment growth here, employment growth in Portland, especially in that professional business services sector. We're not a major financial hub, but finance and information. We've seen those figures slow down over the last year. Some have even gone into the red. So that any pent up demand that we thought might have existed there in mid 2023 is all but evaporated. I'd be remiss if I didn't note the Nike layoffs that are going on. They're going to cut about $2 billion in cost over the next 3 years, 2 or 3 billion in cost. They're going more to a direct to consumer model, so that means less jobs for those that worked with the department stores. And so the Nike effect is, they leased a lot of space outside of their campus on the west side. So we expect some trimming there that could push vacancies a little bit. So yeah, in terms of employment and demand, those things will push vacancies up for another few quarters in Portland, but the lack of supply coming online will temper that. Some submarkets that are outperforming. Elliott talked about vacancies by submarkets, and we're going to talk a little bit about Cruiseway, which is kind of an anomaly in Portland. And it's seen a lot of tenants flee to the area, mostly for safety reasons that they're leaving the core. It's kind of just a complete whipsaw of what happened earlier in the early 2000s. This is a submarket where most of the supply was built in the 80s and 90s. It fell out of favor as the core submarkets became popular in Portland. A lot of creative office additions. They turned warehouses into this really nice new space for tech. And so Cruiseway lost a lot of its allure, but we're seeing tenants go back now, and landlords are employing large concessions. They're drawing them back with big TI packages. So one example would be Trimble, that just inked a deal for about 35,000 square feet at Cruise Woods there, and they left behind a full floor in the Southeast Closson submarket when they did. So just to give you an example of some of the things that are happening on a more micro level there.
We've seen greater increase or decreases in rents than any market outside the Bay Area in the United States. We do anticipate this trend to accelerate.
Very similar for Seattle. I'll move along quick. We expect rent losses on net of about 1.5% to 2%. in 2024 before any type of recovery starts to materialize, quarters down the road.
And then finally, about 500 million in sales in the past 12 months. That's a 90% drop from the most recent peak. And it's also a 90% drop from the inflation adjusted average of the 2010s and close to the 2009 low when sales bottomed out after the great financial crisis.
And in Portland, we saw about 450 million in deals get done. Most of those deals were assets purchased on extremely reduced pricing, and or owner user or tenant purchases. So that 450 million in deals is well below the 1 billion plus we saw in 2019, and it's been a gradual decline since that pre-pandemic high point. And that should a couple other.
Let's skip through these last two.
Yeah. Compare Seattle to some of the other tech-heavy markets. So you'll get a copy of that.
Yeah, this is pretty much what we were saying at the beginning, expecting this to balance out, at least for multifamily, and some continuing challenges with regards to the office market over the next year or so.
That's it.
Yeah, thanks.